all the logic as to why I'm anticipating it. I'm going long here. You can see the actual orders. And don't be discouraged by the 2100. That's actually 2.1% risk. Okay, it's based on a $100,000 paper trading account. And there's some of you like to choke on the fact that it's paper trading. But if you can't appreciate the fact that the precision elements are there with real-time data, because you can't do anything like with market replay on TradingView, you can only trade or execute with live data. So live data is the only way you're going to be able to do it. So you can't be faking it. You can't game it like MT4 and fake it like frauds do. So buy side liquidity, that's where my initial draw on the market is. So this is a market maker buy model, and you can learn more about that in my Scout Sniper series, which is free on this YouTube channel as well. So there's the order block. I'm waiting for price to move away from that. I want to see it expand up above these relative equal highs here. That's buy side liquidity. So my eye, it should be, or your eye should be trained over time, and now my stop is to break even, because if it goes back below after running those relative equal highs where the buy side liquidity is written, that would not be a good thing. So I want to make sure I'm controlling risk. So I want to see this fair value gap, that pink area, act as support. Okay, so what specific level? The high of it. I want to see it expand above it. And as it's starting to go up, I'm watching how price is gravitating towards that rejection block. Okay, and I like the expansion that we're seeing here. And I'm not thinking that we're going to collapse and go the other direction based on all the things I've already outlined. And there is a daily volume imbalance that's already shaded on my chart. You can't see it yet, but I'll scrub the video down on the axis, on the price axis, and you'll start seeing it in a moment. But I just moved the stop up, and I'm going to look to buy or pyramid more of this position as it drops back down into that fair value gap. When this candle closes, I'm anticipating a fair value gap to form. There you go. So now I have a gap there. So I like that gap being there above the shaded area that's pink. So I don't believe that that's going to have to be traded back down through. So that pink area becomes an area of a balanced price range. That's not classic support and resistance. That's not supply and demand. That's not Elliott wave. That's not thing harmonic. Okay, it's algorithmic. And I understand that some of you feel that this is complicated. I've actually had some people already put comments in the videos and say, it's too complicated. I can't do this. Okay, I understand. But I'm not here teaching the people that's going to tap out. I'm here teaching the folks that are really wanting to learn how these markets book price. And it was complicated for me as well. So I'm basically stating that the algorithm is not going to reprice below that, and it's going to be attacking the liquidity at 11,050 buy side. So that's basically above the buy side liquidity pool that's being highlighted in the upper left-hand corner. So I'm moving the stop up. I can trust that the stop will not be hit because the pink area is a protected area. The algorithm does not need to go back down there. And the reasons why is because it's already repriced, and it's aggressively going to attack what? Those buy stops above those equal highs at 11,048. So 11,050, that's where I'm anticipating the next draw on liquidity. But there are two targets before we get there, and I'll obviously mention them as we go. Now that right there is a classic bull flag. I don't want to get wrapped up in thinking it's going to break down, but it comes down into this little area in here, back into that fair value gap that I like. Okay, I like that gap that's not being shaded yet. I like that right there. So I'm telling you with this annotation that watch the support form here. Where at? Right at the top of that fair value gap. Okay, and I want to pyramid more. So the 6th position contract long I have, and now I'm going to draw out that fair value gap here. I want to be in more of the position. I like the fact that we dug down into it 2 times. We went down into that blue shaded fair value gap twice. So I'm putting 2 in there, whereas I normally would have done like 3 or something to that effect. I just want to make sure I'm building more position, and I'm basically saying that naked charts are superior to indicator drivel. Unless you have a time-based chart, you're not going to see these elements. And watch how price shows how it wants to rally. You see people out there that have range bars, or they have Heikin-Ashi or Renko bars. That stuff's nonsense. It's absolutely garbage. It's nothing behind that at all. The algorithms have no respect of any of that stuff. And without a time-based chart, you cannot see the fair value gaps, the imbalances, the volume imbalances, the BISI, the CIVI, all these elements that the algorithm actually refers to. So when I coded these things in price action, I'm looking for price to return back to them with the logic that they will perform as they're coded. So if the repeating phenomenon is identified by you, you're going to see there's certain setups that are going to be very easy for you to trust. Not all of them are going to be setups that you're going to say, oh, I would definitely take a trade based on that, because I have lots of students and I'm expecting large ranges to just now come in. So in other words, I'm expecting price to begin to start moving higher. As long as we're not digging into that pink shaded area, it can dip down into it, but not by much. And I'll explain that as we go. So I'm looking for the beginning of green candles moving up. Notice also that we went from large green candles and now we're in small little range candles. Okay, so the next expectation would be what? Big candles. So if we're bullish, we don't think that that pink area is going to go and break and allow price to go down, then the next series of big candles should be in what direction? Up. Okay, so when I'm annotating my chart, I'm typing out, large range candles are coming or big green candles are coming. I'm studying, and I just went in and bought more. So my position is at 10 contracts. I'm saying this is a final partial entry, but I want to illustrate further if the opportunity presents itself. So 10 contracts is about as much as I wanted to do with this position because it's a big position. Like I'm looking for like 600 ticks. And it's a pretty significant run in price. I've already highlighted the next buy stop or buy side liquidity right above that 11,018 and a quarter. Now right here, this is again the rejection block. So I'm anticipating price reaching up into that. So I'm building all of the framework as you would do in your own analysis or in hindsight when you do your back testing, when you do all of your charts, you want to be annotating them just like I'm doing here, looking at the logical levels. And I taught what the PD arrays are, and you learn more about them in the core content lessons. Now that's a classic bull flag, and retail traders may in fact want to try to go long in here. That right there would cause them to go long because it's a breakout, and they would put their stop loss right below the swing low, just to the left of my most recent partial entry long. And watch what the algorithm does here. It's designed to do this very thing here. When bull flags are correct, and it's anticipating a higher run in price, it will always likely do this very thing right there. Boom, stops are engaged. So now I'm typing out that it will sharply reverse higher here based on what I'm just explained to you there. So now retail traders don't trust that bull flag because they got stopped out. They will not re-enter. They'll be too fearful to get back in. And that's why it's coded that way. Now, again, while I don't have that pink range on the chart again, just know that it can dip down just a little bit below that bottom of that highest blue rectangle. It can do that just by a little shallow little dip below that, and that's all that would be reasonable. And then higher prices would be delivered. So I'm watching price, I'm thinking to myself, okay, while I do believe that range that was shaded in pink that I no longer have on the chart because I want to keep your attention on the very salient moments as price is being delivered, I'm thinking to myself, it might offer an institutional order flow entry, Joe. So it may need to go just a little bit lower, a couple ticks lower. I'm extending the fair value gap. And I'm just, again, reminding you that's where I'm thinking it's going to go. These are all done through TradingView live. There's none of this annotations after the fact. It's all happening real time. And you can see one of the other signatures of why I don't like trading post New York session on Wednesday is because it's like this. Okay, it's not as precise. Like I usually get in on the low candles and get on the high candles, and it's just real muddy during this particular time of the month. And I'm anticipating a likelihood of institutional order flow. So if it trades down and just touches just below that line there, I would go in with another partial and pyramid more and trust the fact that it would not collapse going lower.